Accounting for intangible assets. An intangible asset is an asset that you cannot touch, since it lacks physical substance. Accountants record intangible assets at their cost when they are acquired. Some intangible assets have a limited life and are amortized to expense over that life. Other intangible assets have an unlimited life and are not amortized. However, their reported cost is reviewed annually. If there is an impairment loss, the amount on the balance sheet is reduced and the loss is reported on the income statement. The term impairment is associated with an asset currently having a market value that is less than the asset's book value. Intangible assets can be some of the company's most valuable assets. However, if they were developed by the company, as opposed to purchased from another company, there may be no amount to report on the balance sheet. Examples of intangible assets. Intangible assets include the following and more. 1. Copyrights. 2. Patents. 3. Mailing lists. 4. Franchises. 5. Trademarks. 6. Domain names. 7. Goodwill. Accounting for intangible assets. Intangible assets are normally purchased by the business, but there are examples of internally developed intangibles such as development costs, which can be capitalized providing there is a reasonable expectation of future revenue. Intangibles are shown in the balance sheet under the heading of non-current assets. The accounting treatment for intangible assets differs depending on whether the asset has a limited, finite, useful life or an indefinite life. Accounting for an intangible assets with a limited life, example patent. The cost of intangible assets with a finite life is amortized, written off, over the shorter of its legal life or useful life using the following formula. To illustrate, a patent granted to a business for an invention or purchased from a third party is an example of an intangible asset with a finite life. Generally, in most countries the life of a patent is 20 years. Patent amortization example. For example, a patent is purchased for $40,000 and has a 10-year useful life remaining. In this case, the intangible asset bookkeeping entry to record the purchase of the asset would be as follows. First, debit intangible asset patent account with $40,000, then credit cash account with $40,000. Yearly, the intangible asset is amortized using the formula amortization expense equals cost divided by useful life. The amortization is recorded with the following bookkeeping journal entry. Debit amortization expense with $4,000 and credit accumulated amortization with $4,000. Accounting for intangible assets with an indefinite life, example trademark. An intangible asset with an indefinite life is not amortized, but is tested for impairment and written down to its recoverable amount. The impairment loss is calculated as follows: impairment loss equals carrying value less recoverable amount. For example, if a business has a trademark which is carried in the balance sheet at $50,000, and an impairment review shows that the recoverable amount is only $40,000, then the impairment calculation is as follows: impairment loss is equal $50,000 minus $40,000 to give $10,000. The intangible assets journal entry to reflect this impairment is as follows: debit loss on impairment account with $10,000, then credit accumulated impairment loss account.